So if you're a contractor and you're buying a truck in 2026, the rules just changed in a huge way. The bonus depreciation is back at 100%, which means the difference between nice truck and massive write-off is mostly about weight, business use, and paperwork. So in today's episode, we're going to break all this down so you don't leave money on the table. So let's get started. Hey everyone, if you're new to the channel, we talk all things accounting for contractors here. My name is George. So today's episode is your 2026 contractor vehicle tax playbook. We're going to talk about what qualifies for 100% bonus depreciation, how Section 179 works in 2026, the $32,000 SUV limit, when leasing beats buying, mileage versus actuals, and the IRS audit triggers you want to avoid. So first up, let's talk about bonus depreciation and how it's back at 100%. So with the OBBB, the IRS released guidance confirming permanent additional 100% first-year depreciation for qualified property acquired after January 19, 2025. So if your vehicle qualifies and you structure it correctly, you may be able to take a very large first-year depreciation. But vehicles have extra rule layers. So there's passenger vehicle luxury auto cap, listed property rules, and business use substantiation. So 100% bonus doesn't mean everybody writes everything off. First of all, there's a weight rule contractors must know. And this is where contractors win or lose. A vehicle under 6,000 pounds gross vehicle weight rating, most lighter pickups and SUVs fall here. These can get hit with luxury auto depreciation caps. So if your truck is under 6,000 pounds, you may be capped even if bonus depreciation is 100%. But for vehicles over 6,000 pounds gross vehicle weight, now you're talking about Section 179 plus bonus depreciation and the 100%. So potentially you could expense the full value of the vehicle in that first year, whether you paid for it all up front or not. So let's talk about Section 179 real quick with real 2026 numbers. So the maximum Section 179 you can take in 2026 is 2.56 million, and phase out begins at over just about 4.1 million. So when applied to your 6,000 plus pound vehicle, Section 179 allows you $32,000 of depreciation right off the bat. So that just gives you a lot more leniency in terms of you can take the $32,000 plus the remainder in bonus depreciation. So if you went and bought a truck for $100,000 in 2026 and the gross vehicle weight is over 6,000 pounds, and let's say you only put $10,000 down and finance the remaining $90,000, you can effectively take a $100,000 deduction all up front in that first year between Section 179 and bonus. Now let's talk about the mileage reimbursement rate for 2026. If you use the mileage method, the IRS standard mileage rate in 2026 for businesses is 72.5 cents per mile. The mileage method can be great for lighter vehicles, lower cost vehicles, or situations where you want simplicity. But once you choose methods, there are locking rules, especially for leased vehicles and first-year purchases. So let's talk about buying versus leasing. So leasing can outperform buying in terms of tax benefit if your vehicle will be capped under 280F, meaning it's under 6,000 pounds. You rotate vehicles frequently, and you want smoother deductions and less depreciation math. Buying can outperform leasing when you're trying to buy a heavier vehicle over 6,000 pounds. You want equity and long hold periods, and your income is high and you want that acceleration. So the point is, don't decide at the dealership, decide with the numbers before you talk to the salespeople. Now, what are the common audit triggers or things you want to be steering clear of? So if you use a vehicle 80% for business use, you get to deduct 80%. So if it's 51% or more business use, you really ought to be keeping good documentation. And usually the biggest thing with this is mileage. So I'd recommend using a mileage tracking app, keep calendar records, job site history, and any fuel repairs or maintenance receipts. Again, like I always recommend, with a receipt, just snap a photo with your Google or Apple Photos. You don't need to actually retain the physical receipt. So the rule of thumb is that in an audit, if you can't prove it, it would get reclassified and reversed. So another thing to be conscious of is depreciation recapture, which can be like a bit of a surprise tax bill later down the line. So if you take big depreciation deductions and later sell the vehicle, you may have to report taxable income on the gain up to depreciation taken. So this is one other argument for leasing. It can reduce that surprise issue. And the biggest issue with this is if you were to buy a new vehicle, say for 100,000, it's over 6,000 pounds, take that bonus depreciation the first year. So you get a $100,000 deduction the first year. And let's say the next year you went and sold it for 50,000. Now, since it has no cost basis left, that full 50,000 would be a gain to you and it would be taxable. However, if you held that vehicle for many years and sold it later for a very small amount, it wouldn't trigger much taxable gain. So you want to make sure you plan this all correctly. So again, quick recap for 2026. 100% bonus depreciation is back. Section 179 is 2.56 million. The SUV cap is 32,000. And the mileage reimbursement rate is 72.5 cents per mile. So if you're buying a truck or SUV for your construction business this year, strategize beforehand, have all the numbers straight, and then go and make your purchase. So if you have any questions or you need help strategizing with any of this, our calendar link is down in the show notes. Hope you found this helpful and see you in the next one.